Welcome to part 2 of the Blue Sky Toys solution. In this part of my video solution, I'm going to talk you through what this company should be doing to correct its problems that it has in the future. Don't forget, the Blue Sky Toys is a prediction, so it hasn't happened yet, and obviously there is a problem or two we need to address, or the company needs to address. So let's take a look at the spreadsheet. The actual layout might be slightly different to the one you've got, but the major blocks should all be the same. So cash flow is over here from January to the end of June, which is our reporting period, but I'm showing July and August because of the 2 months credit the company offers its customers. Okay, and the 1 month credit it buys its parts on up here. The profit and loss is tucked away down here, and the balance sheet is over here. This is the first trading period, so any retained profits, the net profit down here of 3,925 is effectively the source of funds on the balance sheet, and the application of funds is up here reflected in the net assets. So the net assets are the fixed assets plus all of the current assets minus the current liabilities minus the long-term liabilities, which in this case is the bank loan. So we have £1,080 cash balance at the end of June and a profit of 3,950 for the first 6 months of trading. So that's our basic figures. And I've got a little check down here, which is, are we right? In other words, does the balance sheet balance? So do the net assets arrived at from the source of applications, which is the retained profits, do they equal the net assets from the application of funds, which is what the company's done with that money, the 3,900, it's available cash, how is it spread it across its assets and liabilities? So it's a very simple equation you can see up here in the formula line. Okay, so what are the problems? Well, clearly when we look at the closing balance over here, that line there, there is a negative in February and a negative in March. And the negative means that technically the company is bankrupt. Now let's not worry about the size of the negative here, or the size of the positives for that matter. It's important that in any future projection there should be no cash negative, no bankruptcy position or potential bankruptcy position. And just to drive home that the numbers actually kind of are indicative only, imagine this company is scaled up by a factor of 10, maybe 100, maybe even 1,000. To have 145,000 negative position in the second month clearly is not a very good position to be in. So we've got to address this. And what we're going to do is look at this case and make recommendations to the company as to what they might do. So, as we saw in the Blue Sky Toys video, one of the ways to solve a cash negative position is just to move cash transactions around. Our outgoings, or the company's outgoings, are in this block here. They're the advertising, phone bill, hire of market stall, excuse me, and miscellaneous expenses. Well, to be honest, none of those are big enough to solve this minus 145. So a simple cash movement like that won't solve the problem. The other cash that goes out is cash for purchase of parts. Now, we know that the arrangement the company has with its parts supplier is on 1 month credit. So the January parts, 1,650 here, purchase value, that's 300 purchases at £5.50. That gets paid in February. Okay, so 1 month's credit, and all of these payments here are shifted 1 month across. So what we could do is actually delay that payment to that month. Now we could do this with the supplier's permission or without. Let's explore it without first. So all we're going to do is move February's cash out for parts into February. So that goes, and that, because it's the same amount, I'm simply going to multiply it by 2. Okay, and then from April, May, June. So we're just delaying 1 month's worth of payments. Now clearly that's sorted out February, as you'd expect it to, from the work cards case study. We've saw before that would solve that negative cash position. But what it hasn't done is have any effect on the negative cash at the end of March. And you wouldn't expect it to, because if we put that back, we're making a movement of cash in these 2 months here, so the closing at that month won't change. Okay, so that remains at minus 80. So the only way to actually correct that is to move both of those. So what we might say is, let's just put that back to 3,000, but then we might move half of that into there. So again, I'll get rid of the times 2, 1650, and I'll add in here 1650. Okay. That solves the problem. So our closing balance now is all positive. So we've solved the shortfall. Okay, so what's the effect of this? We've done this without the supplier's permission. So we are holding up payments in the first trading period, basically. The first, the amount of money we owe the supplier for the first delivery they made, we're not paying for. We're waiting a month. Why would the supplier send us any more parts? Okay, you're going to be annoying the supplier. Doing it without their permission is not a good idea. You can always ask. I'm going to put these figures back. Okay, so we're back to where we were. You could always ask, but why would the supplier give you 2 months credit with no trading history? You may be lucky. They may not. More than likely, they won't. Okay, 1 month's trade credit is normal. 2 months rather exceptional. Okay, so that's still a possibility. We are exploring possibilities here, and the financial model that we're looking at here really just gives us clues as to what to go and what questions to ask and who to ask the questions of. So that's certainly a possibility. The other way, and probably the most obvious, is to see whether we could borrow more money. So if we actually increase that to 650, we would again solve the problem, because our negative was minus 145. 145 on top of 500. 645 would give us a 0. That's no slack in it whatsoever. That would give us a 0 down here. The 650 gives us £5. Okay. So again, if it's possible to increase the loan, then great, that's another solution. The amount of money a bank will lend depends on the collateral, your collateral. And in the case of a small business, it's how much you personally are worth and can put up as a security against the amount of money you're borrowing. So you may or may not be able to increase the loan. And the same applies to short-term credit sources, such as a credit card or an overdraft. Whether you can have those or not depends on your personal ability to secure that increased debt. An alternative might be to say, well, okay, I'm an individual, this is a small business, I'll take out a personal credit card to cover this. It's not a good idea to mix personal finances with business finances. They should be kept well apart. And in this course, I want you to take away the message that everything should be done properly, above board, and fully within the rules of the financial regulations and tax. So that's not a good idea. I wouldn't advise that. Okay, so we have a couple of options, but there's a couple more we can explore. If we look down here at the stock level, this is the closing stock level at the end of every month, and this is in units. We've got 100 units of stock left at the end of January, and it always remains 100 or more, which is kind of quite a lot of stock. What we could say is, in the first month, we'll reduce the purchases, let's say to 250. So our closing stock should drop to 50. So if we make that 250, our closing stock never drops below 0, so we are able to fulfill all of our cash and credit sales. But look, the closing balance here has gone. The negatives have gone. So we've solved our problem. Okay, so what's the implication of reducing the purchases in the first month? Well, the only implication is that if sales take off more than the forecast, and don't forget the cash and credit sales are only a forecast. If, for example, the cash sales took off and it was 160 instead of 60, the product was really popular, the company would not be able to fulfill its orders. It would run out of stock. And there's kind of a reputational potential hit on that. Running out of stock early on is not good. It doesn't augur well for the company in the future. However, what they could do, provided it's only short term, is turn that to their advantage through a marketing effort to say, we've got such a popular product, we've run out, come back next month, we'll fulfill the orders. So some kind of upbeat marketing message could deal with that problem. So again, we have another potential solution. I'm going to put that back for a second. Excuse me. The other thing we can play with is the percentage cash sales. Now this is a strategic decision the company has made, that they're going to sell 30% of their sales on cash and 70% on credit. Now imagine in a largish company, you've got a group of salespeople selling for cash, you've got a team of salespeople selling on credit. You'd give them the targets. Okay, we want 60 sales from the cash team this month and 140 from the credit team. Well, imagine that target setting was slightly different. Strategically, you can play with that. So what does the percentage cash sales have to be to correct the negative cash balance? And for this, I'm going to use one of Excel's more useful tools, which is GoalSeek. I'm going to call up GoalSeek. There we go, GoalSeek, and I'm going to set this cell down here, that's the biggest negative one, to 0 by changing, by changing that percentage cell. So I'm going to ask it to come up with the percentage figure that makes this cell down here 0. There we go, the answer is 34%. So I'll just hit OK to confirm that. And it says that actually, if that percentage is 34.027777, we'll get a 0 down here, and all the other cash closing balances are 0. Cash closing balances are 0. So we've solved the problem. 34%, previously it was 30%. That's not a big difference. That would tell me that actually this business is fairly sensitive to that strategic decision. So if I was running this business, I would keep an eye on the ratio of cash sales to credit sales. And I might say, right, actually, watching this on a month-by-month basis is too coarse. I'm going to look at it week by week. So it needs fairly close management. And that's what this model is telling us. Okay, it's a prediction of what's going to happen in the future. We can see we've got a problem, and we can use the model to explore the what-ifs of solving that problem as we move forward. Okay, I'm going to close this video now because I've covered what I wanted to cover here, and we'll have a part 3 where we'll just introduce a couple of other transactions into this model, just to show you how the numbers in the 3 documents, the cash flow forecast, the profit and loss, and the balance sheet, all link together to make the financial reporting all work together. So, okay, that's part 2 of the Blue Sky Toys video finished. Thank you very much.